Hey all, welcome back to Equity Guru. I'm Parry, your faithful host. Look, one of the things that's separated, I think, Equity Guru from a lot of groups out there that talk about stocks in the microcap space is when things go bad, we tend to make our CEO clients jump through hoops and demonstrate that they know things are bad, firstly. They know why things are bad, and that they're transparent on what is the plan going forward. Now, we've talked about Medexus Pharmaceutical a lot. Company makes around 120 million US a year on current revenue projections. Definitely is a much lower market cap than that. So we've been saying that this is basically almost an arbitrage for a while. You've got a lot of business that you're doing and things look good. But the last couple of days, since most recent financials, the stock has peeled itself away. Ken, what do you put that down to? And what's the solution for it?
Yeah, it's a good question, Chris. Clearly, I think there are people out there that are worried about the debt. And so we specifically addressed that in the call last week, just to describe to people that, look, there's a certain amount of debt that the company can easily carry. As you mentioned, we're well over 100 million in revenue. We're producing 5 million of EBITDA per quarter. And we've been doing that consistently. So, clearly you can carry some debt. That's expected. The mid-cap debt that is due, 10 million of that is a term loan. It's only 10 million as a term loan. That's easily refinanced. And the rest of it's a revolver, meaning it continually turns over. You use that as working capital in your business. So, that is easily managed. And we've described that we're in the late stage of a process to refinance our debt with a large institutional lender. And so, we think we'll do that at very good rates. And then we have an eye on the debenture. I mean, the reason we're doing this is because we want to be prepared for the debenture, which is next October. And that's the debt we've got our eye on to say, hey, we just want to make sure we've got the option to pay that in either cash or shares. And I think a lot of people don't really understand how that debenture works. If we wished, we could simply pay it in shares. But obviously, we want to have the option to pay it in cash, because if the share price is really depressed, we don't want to take that dilution. So, we're working towards having that option. That's really where we're focused at this stage.
Got it. So, I guess a lot of shareholders, they'll see on a message board somewhere, a company owes 38 million, due in October, has 10 million in cash, bankruptcy ahead. But that's obviously a large simplification of the process. First of all, you've got 2 quarters to figure out what your game plan is. Second of all, I don't think that if you have an option that's otherwise, that you would allow the dilution side of things to take place. Like going from a $20 million shares out to diluting $38 million worth would basically be something that would get shareholders to a torches and pitchforks standing, I would imagine.
Yeah, absolutely. And, clearly, I'm one of the largest shareholders. So that dilution issue, is forefront in my mind. And I talk to other shareholders all the time. So again, it comes back to having the option to pay in cash or shares or some combination of those two. Then in October, when a decision needs to be made as to which route we go, we have those 2 options. And if the share price is not fair, then we can pay it in cash. It's at the company's discretion.
Right.
The venture holders will not make this decision. The company will make that decision.
So the company itself, minus the debt overhang, on a quarter-to-quarter basis, you're fine. You had 10 million in cash in the bank 2 quarters ago. You still do. So business is being done. You've got assets that are there. There's obviously revenues coming in. We've talked about that many times. Your market cap is less than 1/4 of your revenue, which is insane. So this is really a case of, if I'm a banker, if I'm sitting on a lending fund, and Ken comes up to me and says, so here's my revenues over every year, here's my costs, I'm pretty stable, I need a better deal than what I've currently got. I would imagine that that's not something that's a stretch to lock that down.
No, it's pretty straightforward. I mean, the bankers are looking for stable businesses with dependable revenue that produces good cash flow, which is us. I mean, we've got 5 quarters of strong revenue growth, 4 quarters of strong EBITDA, now hitting records in terms of both revenue and EBITDA. So clearly, we have a profile that's attractive to a large institutional lender, and we're in the late stages of negotiating that. So, we're very confident that that solution will be in place soon. And I think a lot of the concern is completely unfounded.
If you could wave your magic wand and just sort of decide how this is going to go, like what would be your preferred scenario as to how this all plays out?
I don't think we have a preferred scenario at this stage. We're still talking, many quarters out. And so, it goes back to having the option. You want to have optionality at that time. And so depending where the share price is, we'll decide. We don't know at this stage. Clearly where the price is today, we'd want to do it in cash. But, who can forecast where the share price is going to be in October?
Right. Well, certainly you've got a few people out there that are forecasting, and you've got a few analysts that have been putting $3 and $4 price targets on your stock, which currently today is sitting in the mid ones. So certainly guys that are paid to look at what you're doing for a living and assess where you'll be 6 months down the line feel like the debt issue isn't a killer. But you know how retail investors go, like when there's blood in the water, they tend to all sort of reiterate each other's opinions right the way down the line. Do you see a point, obviously you're in the midst of discussing all this, talking about it all, but do you see a point in the very near future where you'll have some certainty about this?
Yeah, absolutely. I mean, I think our view is that we want this dealt with sooner than later. I mean, that's why we brought it up on the earnings call last week, that we've been in this process. It's nearing the end of the process. So, a solution we expect will be announced soon. And I think when investors see that, they'll recognize that, the mid-cap debt is not an issue. And we've got an answer for the debentures in October. So, I think the sooner we put that out, the better. Probably makes a bit of a buying opportunity for people who recognize that now. And, we'll as soon as we've got something to say on that debt issue, we'll put it out.
Okay. Certainly, Marcel Conrad, your CFO, was quoted in the last financials saying you're at the advanced stages of a competitive process to deal with short-term liability. So I'm translating that as discussions are being had currently.
Yeah, this is the second quarter that we described that. Last quarter, we said we had just initiated it. Now we're basically saying it's near its conclusion. So, right. Investors should expect a conclusion soon.
A lot of pubcos, that are in this situation, and that is most of them. Obviously, a large number of companies go and seek debt financing for growth and project acquisitions. A lot of the time they shut the hell up about it. They don't tell anybody about the process. You just they wait for people to dig through MD&A documents and figure it out for themselves. So this is interesting that Medexus has chosen let's be upfront and tell everyone what's going on and make no bones about it so that no one's caught by surprise. And still not getting any respect for that.
Yeah, perhaps not. I mean, but we did think that's the right thing to do. And you could see, long-term debt moving to current liabilities. So obviously that, should raise questions. And so we thought best to answer those questions before somebody tries to speculate for us. And so right. They still speculate for us, but
the internet is prone to do.
At least we've put out, what the plan is, what we're doing about it. And I think when this all plays out, we'll have done the right thing.
Now, certainly, your last few quarters were very focused on increasing revenue, right? Treosulfan is going to do what Treosulfan is going to do. But your revenue numbers have been projected as higher and come through along those projections. Do you sense that maybe the next quarter would be one where costs might be something to really focus on to sort of give the market that encouragement that the EBITDA is going to grow?
Yeah, I think we're structured the way we ought to be for the size of business we are. So I don't think our SG&A or OpEx is really going to change that very much. And so, revenue might grow a little bit. And, we're kind of in the new normal. We did 28.7 last quarter. That's a good number. That's a full quarter of Gleolan. So, we're in the right range. The OpEx won't change a lot. So we'll produce, roughly the same sort of EBITDA. I think what will change is that the, amount of free cash flow will increase because we're not going to see increases in inventory. We're not going to see increases in working capital the way we did when we had 35% growth. The free cash flow follows that increase in EBITDA. And so, I think people will start to see that free cash flow come through. Which, again, will alleviate some of the concerns about the debt.
In terms of, I always like to think that, companies go through several growth cycles and sometimes the opposite. Lessons are often learned that, you maybe do things differently if you had your time over again. But I struggle to think what Medexus might have done differently in terms of raising the money it did, when it did, how it did. It doesn't strike me as an error in business. It strikes me as something that was just, the messaging is always going to come eventually that the bill is due here, and how you get that bill paid, you've got lots of time to figure it out and make it something that isn't going to catch anyone by surprise. I think the fact that you've actually come out ahead of time and said, look, here is what we're doing revenue wise, and nailed it, and that you've come out ahead of time and said we're in the process of figuring out this debt situation. I would imagine that it's likely you wouldn't have done that if you didn't think you could do it. So this is evidence of a mature company that believes in transparency rather than what it might be chatted about on the internet in 20 character sound bites, which is, oh my God, there's debt.
Yeah, no, I think you're exactly right. Our mission here is to grow a business and do it responsibly. And part of that responsibility is communicating clearly to shareholders, many of whom are institutional shareholders. So, we want to make sure we're being upfront about what we're doing. Yep. And you're right. We beat every analyst's expectation, both on revenue and EBITDA consistently. And so I think the last piece of the puzzle is sharing with everybody what the plan is for the debt. And so once that piece is out of the way, hopefully there'll be or less speculation about, what we're trying to do. The business is performing really strong. We've got, excellent metrics. And, we think eventually the market will recognize that.
In 2022, you did US 76 million in revenue. You've beaten that and you've still got one quarter to go. That's in and of itself, one would think would be good fuel for stock elevation. But, you're at a place where probably because of a couple of missteps over the past couple of years that were not necessarily in your control, people point to the next thing and say, here it is again. Here's MDP again, on a downward move. When do you think that there's a point where the market will give you the credit for the good stuff? Because obviously right now there's lots of good stuff, but it's not the lead. It's kind of buried in the bottom of what people are talking about.
Yeah, eventually I think they will. Look, we're 35% growth last quarter. As you mentioned, we've already guided that we're going to be over 100 million in revenue this year. 25% growth year over year. Those are substantial numbers.
Yeah.
We've done so without deploying a ton of capital. If you think about Gleolan, it was only, single-digit millions of dollars to acquire a $16 million asset. So, I think we've been pretty efficient with our capital. That's why our cash balance has been steady and stable. and that's why we qualify to go to a big institutional lender and get debt at a good rate.
When your stock is having bad days, do the institutional lenders care?
Only thing the institutional lender cares about is will they be repaid?
Right.
That's their concern. So clearly, they're looking at the business metrics. What the capital market is doing is not as big an issue.
So the debt basically comes down to 1/4 of revenue plus the cash you've got in bank. So, I think it'd be people that are, on the dark reaches of the internet saying bankruptcy coming. That doesn't make any sense to me whatsoever. This is an organizational challenge that down the line might cost you a bit of money to redo, but this is something that growing companies deal with every week.
Yeah, it's ridiculous that any institutional lender would get concerned if you're leveraging yourself over 3 times EBITDA. I mean, and if you look at our EBITDA, we did five last quarter, so that would suggest $20 million a year. So 3 times 20, I think, comes out to $60 million worth of debt, and clearly we don't carry that.
Right.
And so, we'll take care of that mid-cap debt. We'll have some cash left over to take care of the debentures, we think. And then plus the cash that we'll generate between here and there will give us a solution for the debentures, should we decide to pay them in cash. And again, it comes back to having the option.
Now, this debt was actually taken out in 2018, am I right? It's been 5 years.
Yeah, correct. It's a convertible debenture that was put in place when we did the amalgamation at the formation of the 3 companies. So yeah,
it's the money that built Medexus.
Exactly, and these are shareholders or investors who have been with the company for a long time. Many are also equity shareholders, and many of them are institutional investors. So they want to see the company grow. So they're not looking to see us harmed and filing for bankruptcy. That is certainly not on the agenda.
Doesn't help their position in any way, shape, or form.
I don't think so. No.
Are the existing debt holders, are they part of the conversation in terms of renewing and changing the terms of the debt?
They're not on the existing debt. They obviously are close to us. Most of those debentures are held by 8 groups that are very close to us. So we can reach out to them at the appropriate time.
Okay. Now, in the last few times we've talked, there's been discussion about maybe new licensing, new products joining. Does this process slow that down, or does that process continue unabated?
It continues on. Yeah. So, this is part of our business model. So clearly, the partner that we've selected, we've made it clear what, our business model is, and they understand that. So that is part of our business. So the BD effort continues on, and we've got many discussions that we're pursuing. So hopefully we'll have something to put out soon that will, allow us to build the company in the future.
Is there, if you could take any potential investor and shake them by the head and say, listen to what I have to say to you, is there like a 25 words or less that you'd like to get into all their heads?
Yeah, I think the point is that we've got a great base business that can support debt. And so the debt refinancing is a natural process. And we'll get through this and then continue on our path.
And meantime, anyone that wants to be going and grabbing stock at $1.20, $1.30, I feel like they're on a pretty good thing there. Like, yeah. You've got to be looking at it yourself saying, oh, okay, how much money do I have on the line of credit right now?
It's a heck of a buy. I mean, to think it's at those levels, it's incredible. If you think the various multiples, you put that versus our peers, you can see it's an incredible buy.
There's only 20 million shares out there, so it's like $24 million market cap right now. Like, that's insane for $100+ million US a year in revenue.
Yeah, I mean the multiple of revenue.
10 million in cash.
You look at our peers, it's 3 times revenue.
Sometimes these things are all about perception. Like you have a couple of shots go between your legs, and people say, "Oh, that guy needs to be moved on out." But a couple of wins can go the other way as well. Certainly, the all of the analysts that are giving $3, $4 price targets are looking at that debt and saying, "Well, that's a challenge, but it's not a game ender by any stretch. It's worst comes to worst, it's dilution, which would justify a drop in your share price. But if you turn that deal around and throw it another 3 years down the road, that whole issue is gone."
Yeah, absolutely. This is normal course. I mean,
Yeah.
this is debt that's been in place since we acquired EQUITY. So, of course, it's going to get renegotiated at the appropriate time. And now is the appropriate time. So this is nothing unusual about this. This is normal course. And I think anybody looks at our business, they'd see that this company's gone from 10 million in revenue to over 100 million in revenue in the last 5 years. We've had tremendous compound annual growth. And positive EBITDA to support that. So, it's been a tremendous opportunity and a success in what we've done so far. And we're just going to keep growing it because we're not where we want to be yet. We want to be much, much larger, which means more products coming in.
I've seen on certain message board websites that will remain unnamed because they are swamps, terms like death spiral financing. Look, I'm as incredulous as the next person when I see a company that surprises the market by showing that they've got a lot of debt they can't handle. But this is not that. Like, this is so far from that. Death spiral financing is, you do a deal with somebody who's shorting your stock to drive it to zero to get as many shares out as they can. Tell me if I'm wrong, but this current deal, they can convert $6 a share if they choose, which they're obviously not going to do. But they don't have like a detonation button where they can say, "Well, you're down to $1.20. We're going to convert there."
No. The option is not within the debenture holder. They could convert at 6.20. They won't, obviously. And then it's up to the company to decide to pay in cash or shares. So no, there's no mechanism that would cause this spiral. I mean, that's simply not there.
Yeah. And bankruptcy is not a thing because you're driving in that revenue. So really, this is a case of a little admin work and finding some new friends.
Yeah, absolutely. And natural process. I mean, you eventually want to be with a much larger institutional lender. I mean, that's what supports growth. So this is what we want to do, is to be with a bigger lender that can provide capital in the future to support our growth. It's just normal course.
The devil's advocate, which I'm known to be happy to do. Interest rates not so great right now. You're paying 6% on the existing deal. Do you feel comfortable that you'd get something similar to that in going to the market now looking for debt?
Yeah, we do. Again, we're going to a much larger institutional lender, and so they can provide their cost of capital is lower. So we do think we'll get a very competitive rate.
And obviously, when someone's putting a debenture together for essentially a startup or a new combination of a company, the risk levels are through the roof. So your risk levels right now are much, much different. Now you have an established company doing business.
Yeah, absolutely. I mean, again, when you produce this type of EBITDA and then eventually free cash flow, that gives a lot of comfort to the lender.
Do you have a sense of anybody within who has large holding of the company that's run out of confidence? Have you had discussions with people who are like, Ken, Timmy needs a bicycle here. Like, what do you got for me?
Yeah, I mean, well, I own 10% of the company. And so I still have a ton of confidence that we're going to continue to grow the company. I mean, we've had great success to this point and expect that to continue. The other large shareholders, yeah, absolutely. We talk on a regular basis and looking for ways to continue to fill that mission. The mission from the beginning was to get up to $500 million. We want to achieve scale. You have to be much bigger. So 100 million is not the destination. 500 million would allow us to have the type of scale, produce the free cash flow that will allow us to do a lot more.
So a $24 million market cap looking to get up to 500 million would be quite the return for investors who have the faith.
Yeah, absolutely. I mean, that's where, significant wealth can be made.
Ken, you've been in the markets for a while. You've seen guys come and go, and I'm sure that when things are happening like what's happening right now, you get a lot of calls from uh, dudes at various funds that'd be more than happy to help you out of the situation and put you in a much worse one. Is that the situation on the ground right now, or are you just not in that space?
No, we're not at all in that space. I mean, as we said on the call last week, we're in the late stage of discussion with a large institutional lender. I mean, that's where we should be. I mean, we don't need the capital from other sources, so we wouldn't go there.
The Would you do it all over again the same way? Would you be as open that you were talking to people about the debt, or would you just leave it until you had a solution to announce?
No, I think it's the right thing to do is be transparent. I mean, I think shareholders expect that. So no, I don't. Of course, we don't want to see the stock go down, but we will continue to be transparent. It's simply the right thing to do.
Well, credit where it's due to you, and I've always given you this credit. It's like you've done what you said you were going to do. Things that are outside your control, FDA delays, etc., notwithstanding, everything else that you've news released at this company, you've gone out and actually achieved what you promised. So I feel pretty confident right now at $1.20 that I should be making a call to Mackie right now and putting some buys in, because honestly, we thought that at $1.80 it was a good deal. When you look at the market cap compared to the revenues, we thought at 250 was a good deal. So $1.20, Jesus Christ, man! Like if you're just going to give me the stock for nothing, I'll take it.
Yeah, I think this is an unusual situation. So clearly, it's created this buying opportunity. I don't expect that it's going to stay at these levels for very long. I certainly hope it isn't.
It's always an adventure on the public markets, man. Let's hope sanity prevails.
It is. Again, good reason to get much larger, right? Get out of the small cap space where you see bigger institutional investors, more stable investors.
Do you think this is a particularly Canadian markets thing?
I don't know. It's really hard to judge. I mean, I think we have shareholders both sides of the border, so not really sure what's causing it. It could be coming from either side. Who really knows?
Yeah. Okay. Well, we'll keep an eye on things, and we'll get this out as quickly as we can so the market understands exactly what they're looking at.
It was great chatting with you, Chris.
That's Ken D'Entremont from Medexus Pharmaceuticals. MDP is the ticker symbol. And man, who would wish their worst enemy to be a public company CEO?
There are days, I got to tell you.